Hello, in today's video we'll be taking a look at the Friday, April 17th, 2026 trading session for the SPX CBOE index. We'll be utilizing three different indicators. One is the SPX daily key levels V3.0 indicator, and then two add-on indicators. One is the day trading GPS ribbon indicator, and then the other is the day trading GPS VWAP for SPX CBOE. Okay, so if you've seen some of our other recent videos in which we introduced our two new add-on indicators, one is the ribbon indicator that has the option for indexes, and then the other one is the VWAP for SPX. So some of you who have not seen those videos, on TradingView for the two symbols that are from the CBOE, which is the official exchange for SPX, the SPX symbol, and also the XSP, which is the mini SPX symbol. There is no native VWAP available to use for those symbols on TradingView. If you try to use the native built-in VWAP for SPX CBOE or XSP CBOE, which is the mini index, whether you use the native volume weighted average price, which is the native VWAP for TradingView, or the native auto anchored VWAP, neither one of those will work. You will typically get a red exclamation point showing no volume data. It has really nothing to do with TradingView or a problem with TradingView or a bug with TradingView. It's simply the fact that the CBOE global indices feed that TradingView gets from CBOE for the real-time data for the SPX does not provide any volume data, so consequently any regular type of VWAP that you're trying to use on those two symbols will not work because of course VWAP is based on volume in part. So we have developed a VWAP that will work on those two symbols that accesses an external data source that's different from the data source that for the CBOE global indices outside of that, and then it works on both of these symbols. Also, our ribbon indicator also comes with a optional filter for indexes. And so what the advantage of this ribbon indicator is that you can do a dual screen, one with the filter on for indexes and one with the filter off, which we'll take a look at in just a moment. First, we're going to run through all the trades of today. We're going to do something different today than we normally do. We're also going to look at an additional strategy than our typical strategy. So we're going to look at the normal strategy, which involves with this indicator, there's always going to be three main option strikes that you can use on any bullish or bearish trade from any of the main key levels. The main key levels being the bull bear key price level, as well as the R levels above R1 through R6 and the S levels below S1 through S6. The five contextual levels, the pre-market high, pre-market low, yesterday's daily high, yesterday's daily low, and the yesterday's daily close. You do the stop loss and take profit on those through the user control panel directly. So I'll just show you that real quick before we move on. You go down to the user control panel. You will go to that trading section for those five contextual levels, which is found right here. Stop loss and take profit levels for PML, PMH, YDL, YDH, and YDC. And you simply enable which particular bullish trade entry you want to take on which of those five contextual levels. If you're taking a bearish trade, you simply go down to the bearish section. In the case of a bullish trade, you just simply go to the specific one that you want to trade off of. And this example for example PMH pre-market high, you select standard or tight stop loss. It will print the standard or tight stop loss for that level on a bullish trade on the screen, and then you would select your take profit using the reward risk multiplier, which the default is 2. You can make it less in 0.25 increments if you want to go less than 2, or you can make it more than 2 in 0.25 increments all the way up to 30. Okay, so we're not going to run through all the different aspects of this indicator in today's session. We're mainly going to run through the additional new strategy as well as the standard daily key level strategy. And if you want to know more information about this indicator, you can look in the description of this video for additional links. There's a setup, inputs, and features video, as well as other session videos that are longer that go into more detail. Okay, so we have our opening candle here, the 9:30 a.m. bull bear key price level alert for that 9:30 a.m. opening candle. We're on a 2-minute chart. This indicator you can use on chart time frames of 1 minute up to 30 minutes. However, for the specific daily key level strategy that we outline in all our videos, as well as the additional one we're going over today, the recommended time frame is 2 minutes, and the recommended time frame zone in general is going to be 1 minute chart up to a 5-minute chart. So if you prefer a different time frame than 2 minutes, you can certainly use something between 1 and 5 minutes. However, we have found the 2-minute to be the most consistent performer. That's why you'll see that in all of our SPX videos as far as utilizing this indicator for our daily key levels trading strategy. So we have an opening BBKPL level alert here. That is the BBKPL level alert that you find in the indicator down in the alert section. We have alerts for closes above and closes below all of the different key levels and contextual levels. However, we also have a special 9:30 a.m. opening candle close alert, especially for the BBKPL level. So this is giving you your initial bias for the session. That also comes with a range filter you can apply, which you should apply. The default is 85%. On that, you should leave it at that percentage or make it less if you want to make it less than that. The reason it's at this percentage is this is the maximum percentage it can be for a bullish or bearish trade off of the bull bear key price level for the close of the candle to be within the acceptable range considering the risk reward parameters on that opening trade off of the bull bear key price level. Now we use the ribbon indicator to confirm our entry. So for example, if this was a close above giving us the bullish alert signal on the opening candle here, but this ribbon was, instead of being green, was red, then there would be no trade on that particular opening candle. There would be no bullish trade because we're getting conflicting signals. So what we're looking for is confluence of signals between both the main indicator for the key levels for closes above and below key levels, as well as confirmation from the ribbon indicator. Also, if the ribbon indicator was multicolored, in other words, if the ribbon indicator was partially red and partially green, then also there would be no trade because we're getting conflicting signals. So you're looking on a bullish trade for the ribbon to be all green. Ideally, you're looking for some pull away of the top part of the ribbon as well. That's ideally, if it's just all green with no pull away, that still can be fine, but you're ideally looking for some pull away of the upper bands on a bullish trade. And in the reverse, on a bearish trade, if the ribbon was all red, you'd be looking for some pull away, ideally on the lower bands. So here we have this, but however, we do have a very large gap up. As you can see here in our market scenario, it still says top overhang. Why does it say top overhang instead of gap above? The reason why is because even though it is gapping above, the pre-market low that we had for this morning was still below the YDH level. So a true gap above. And if this was the other market scenario that we have, there's 6 different market scenarios, one of which is gap above, and it means true gap above, what that means is that the entire pre-market range of PMH to PML, all of that range is above YDH. And since the PML is below YDH, that is why this is a top overhang poke above instead of saying gap above. Okay, and we're not going to go into all the aspects about the market structure scenario. Just know that if you want to go take a look at some of our other previous videos, we've gone into more detail about why market structure is very important. And we also have a market structure analysis table that you can turn on, which will give you key trading characteristics and dominant tendencies, along with other relevant information you need to know about the specific market structure scenario in play for today's session. So for example, you go down here and you turn that on, and at the first tick of the 9:30 open, it will give you a market structure scenario analysis table with all that information. You can adjust the size of this. You can make it smaller or larger. That is the normal size, which is the default. We also have one-page PDF cheat sheets. If you don't want to have that table on your chart, you can simply go to the Google Drive for the one-page PDF cheat sheets, or download them to your computer and or print them out and use those either on a second monitor, or just print them out and have it next to your computer to look at. Okay, so we have the 9:30 a.m. opening candle here, bullish. We also have the ribbon being all bullish, so that's a confirmation from that. Now, if we look at the ribbon indicator with the filter on, then as you can see here, we're getting finally the pull away on this one. So if you're going to go off the ribbon indicator with the index filter on, then you would be taking the entry instead off of this 9:34 a.m. candle, because that's the first candle where we have the green, we have a close above the bull bear key price level and the pull away from the upper bands here. So like I was saying before, one advantage of this ribbon indicator is that you can do it on a dual screen and make an assessment from both of them at the same time. So we'll take a look at that real quick before we move on to the rest of the video. All right, so here we have on a dual screen here, we have this side has the filter on. This side has the filter off. Both of these have the VWAP as well. The VWAP also has the VWAP bands. The VWAP itself is this bright blue line. It's normally VWAPs are normally yellow, with the bands being different color. However, since we have these two thick MA bands within the ribbon that are default yellow, the default color for the VWAP is going to be bright blue. However, you can change that if you want. For example, we'll just look at the user control panel, so you can simply go in here and change it to something else, and then you can also change the upper and lower bands. There's also a show background highlight on extreme 3-band moves, either above or below, that you can turn on. You can also control the line width. You can also do different, you can do it by session, by week, or by month as an example if you wanted to use this VWAP. In other ways with SPX, if you're also doing some swing trading with SPX on top of day trading with this indicator, if you're also doing some swing trading, that can come in handy as well, as far as looking at the VWAP under different scenarios. Okay, now we'll go back to the other chart. Okay, so I mentioned earlier that we're going to be looking at the standard strategy as well as an additional strategy today. The standard strategy involves, there's 3 different strikes that you can use on any bullish or bearish trade from any key level, any main key level. The bull bear key price level, the R1 through R6 or S1 through S6. In this case, and in most cases at the beginning of a session, and about 90 to 95% of the SPX sessions that you'll see in a normal year, the bull bear key price level is going to be the main level in play during the opening moments of the session. So in the case of a trade from the bull bear key price level, we'll go over the strategy for today. The standard strategy on this is that you are using the strike that is closest to the level that you're basing the trade on. In this case, we're basing the trade on the bull bear key price level. 7088.59 is today's bull bear key price level. The closest strike to that is going to be the 7090 strike. So it's a call option. And so we're going to be utilizing the 7090 call option as our standard play. Now, the 2 other strikes in the standard strategy are going to be as follows. So you look above, in this case, since it's a bullish trade, you go to the first midpoint above 7098.65, and that would be your alternative strike, your first alternative strike you could use. And the closest strike to that 709865 price is going to be the 7100 call. The furthest out of the money strike with the standard strategy that you've seen in all of our videos before is the full 1 level away in the direction of the trade. So that's going to be the R1 level, 7108.71. So that's going to be, for today's session, the 7110 call strike. The additional strategy that we're going to go over today is using the target for the regular trades. The levels for the 2 levels that we normally employ for the targets for the regular trade, and using those strikes that are closest to those levels as an opening lotto option trade. So the reason why this is called an opening lotto option trade or early session lotto option trade is because of the fact that these are going to be a lot cheaper options. They're a lot further out of the money. However, they are at the strikes of the normal regular trade target. So the regular trade target on a bull bear key price level trade is the minimum 1.5 level threshold move in your favor, which that would be the mid R1, R2. The other one is the minimum ideal move, which is a 2 level move. That is going to be the R2 level because it is 2 levels away from, in the direction of the trade, from the level that you're taking the trade from and basing the trade from, the bull bear key price level. So in this case, mid R1, R2 is 7118.78. So the closest strike to that is the 7120 strike. The R2 is 7128.84 for today's session, so that is going to be the closest strike to that is the 7130 strike. Now, the reason for this additional strategy is for people that want to put up less money to buy the SPX options to begin with, and thus have less money at risk from the get-go rather than buying the closer in options that are going to cost a lot more and potentially have more risk should it go down to the stop loss. Excuse me. So the stop loss on utilizing this indicator when you're taking a trade from one of the main key levels, the tight stop loss is going to be on a bullish trade, the QL level below the main key level you're basing the trade on. In this case, that is the bull bear key price level, so the QL below is our tight stop loss, which, as you can see here, if you use that, you would have been stopped out here. The standard stop loss is the first midpoint level below the level that you're basing the bullish trade on. That is this level here, the mid BBKPL S1. So that is 7078.53. As you can see, that did not get stopped out. And if you've seen our other videos, we do recommend that you use the standard stop loss. The reason that both of them are there is that some traders prefer tight stop losses as opposed to standard stop losses, and that's fine. It's just that obviously the tight stop loss is going to get stopped out more often than the standard stop loss, and then you would have to re-enter a trade if you're going to continue trading and look for the next bullish or bearish opportunity if that happens. It works the same way in reverse on bearish trades. If this was a bearish trade off the bull bear key price level, then the QL above would be your tight stop loss. And the the midpoint above would be your standard stop loss on a bearish trade. Works the same off the other R levels and S levels. So on a bearish trade from R2, it would be the QL above or the first midpoint above the standard. If it was, for example, a bullish trade off of R1, you would turn on the QL level below R1 if you want to use the tight stop loss for a bullish trade off of R1, or standard stop loss first midpoint below R1, which would be this level here, mid BBKPL R1. Works the same way on the S levels. Tight stop loss on a bullish trade from S2 would be the QL below S2, whereas the midpoint below S2, mid S2, S3 would be the standard stop loss. S1, QL below S1 would be your tight stop loss in a bullish trade from S1. Your mid S1, S2 would be the standard stop loss for a bullish trade off of S1. Okay, so we have all of these in a row here. So we're going to go through each of the different strikes. There's going to be 5 different strikes because we're going to have our 3 regular strikes and then our 2 for the new additional strategy that we're going to go over. Now with this indicator, there are 2 different types of trades that you can take. One is a scalp-only trade. The other is a regular trade. The scalp-only trade primarily has one exit, and that is a 1-level move in your favor. A 1-level move in your favor is calculated from taking the level that you're basing the trade on, in this case the bull bear key price level. You look in the direction of the trade, in this case up, since it is a bullish trade. R1 is your scalp only exit. A regular trade is one of 2 waypoints. Either you can use the 1.5 level move in your favor, which is the minimum required move. That, in this case, would be the mid R1, R2 level. That is the 1.5 level move. Or you can use the 2-level minimum ideal move. In this case, that would be R2. The difference is that either one of those waypoints, you have several different options as to how to handle your regular trade. So with a regular trade, you're looking, of course, for more profit than a scalp trade. So on a regular trade, you can exit 100% of your position, just like you did with a scalp. The second thing that you can do on a regular trade is that you can take all of your original position and you can adjust the stop loss on it to break even. Break even in that case being the price that you paid for your options at the entry. So at the beginning of a trade, at the initial entry, your stop losses are going to be level based. However, when you're adjusting your trade on a regular trade, adjusting the stop loss, you are then switching to then adjusting your stop loss to break even the price that you actually paid for the option, not moving your stop loss level to the level that your trade was executed at. You are instead changing it to the price that you paid for the option, or if you want to add a small initial profit buffer, you can add 10 to 15% on top of break even. And you could do that either at the 1.5 level or the 2 level move. The other alternative at either one of those waypoints is going to be only applicable if you are trading 3 or more options. If you're trading 3 or more options as your initial position, then your third alternative that you can do at the 1.5 or 2 level move in your favor is that you can scale out and close out 60 to 90% of your position. So let's say, as an example, you started off with 5 call options. When it hits either the 1.5 level move or 2 level move, whichever one that you're going to prefer utilizing in your trading for your regular trades, then if you sold 3 of those 5, that would be 60%. If you sold 4, that would be 80%. If you had 10 options and you sold 6, that would be 60. If you sold 9, that would be 90. If you started out with only 3 options, the minimum, and you sold 2 of them, that would be roughly 66%. So the idea is between 60% to 90%, i.e. the majority of your position at the 1.5 level to 2 level move in your favor. Then you've closed out the majority of your position. Then with the remaining portion of your initial position, those are going to be remaining runners. And then what you do with your remaining runners is you adjust your stop loss to break even the price you paid for them, or break even plus a small profit buffer. Then you manage your trade level to level with those remaining runners as it keeps moving to additional key levels, being either main key levels or additional midpoints in your favor after the initial threshold that occur in the path after the initial threshold is met. Then you can either exit all of them at the next level move in your favor, or further adjust your stop loss on all of them at the next level move in your favor, or do a combination of those two, take off and close out some of the remaining runners and adjust your stop loss further on whatever ones are left. Also, if any contextual level occurs after 1.5 or 2 level move in your favor, those also count as additional waypoints. In this case, that's not going to be the case on this particular trade because all of them are below the 1.5 or 2 level move. Okay, so on the 1 level scalp move here, first we'll look at all the entries off of all of these different strikes. So first we'll just go to the 3 standard strikes. We have the 7,090 call, the 7,100, and the 7,110. As you recall, the 7,090 was the closest to the bull bear key price level. That's known as the standard play, the standard at the money. And then the 2 alternative, slightly out of the money strikes are going to be the strikes closest to the midpoint in the first level above. Those are going to be the 7,100 and 7,110s. You're entering on the close of this candle. So the close of the 930 candle, the ask on the 7,090 is $15.90. That's going to cost you $1,590 per option. The close on the 7,100 is $11.20 on the ask on the close. That's going to cost you $1,120 per option. The 7,110 is $760 on the ask on the close. That's going to cost you $760 per option. Now let's look at the 2 lotto options. Mid R1, R2, 7118.78, so that's going to be the 7120. 7128.84, that's going to be the 7130s. The 7120s are $5.20. That's going to cost you $520 per option. Whereas the 7130s are $3.50. That's going to be $350 per option. So you can look at it this way on these if you're wanting to employ this particular strategy instead of the standard strategy involving these 3 strikes. You have a lot less money that you're laying out than with these 3, particularly as opposed to these beginning 2. You have either $520 or $350 per option here. Now you can still use these two stop losses here on these particular trades. One thing to keep in mind with this lotto option strategy, which for an early session lotto option strategy, if you're going to be utilizing these instead of these, is that this is a strategy where you're going to be getting out of these options during the early part of the session. So you're looking for maximum leverage with the use of these lesser priced options. You're looking for maximum leverage, but you're also looking to get out of these trades sometime during the morning part of the session. So if they're not working out, then it's best to just get out of them later because they will lose money a lot more rapidly in the afternoon as they are further out of the money. So price is just dribbling along here and going sideways and not really going up as it did in this particular session. If it starts just chopping back and forth and it's not taking your stop loss out and it's not really going anywhere either to either at least not even making it to the scalp only exit, then you are best to get out of them before lunchtime. Okay, so first we're going to go through the standard 3 options and then we'll come back around to the lotto option plays. Okay, so going through this, the R1 level of course is your scalp only exit. This candle here at 9:58 just comes up short. It does not hit the R1 level. This 10 a.m. candle hits the R1 level. So on the candle close here, we started out at 15.9 on this one, and the R1 hit. It's now on the bid on the candle close, $27.40. The 7100 that we started at $11.20 is now $20.20. And the 9:30 a.m. the 9:30 a.m. Close entry here on the furthest out of the money on the regular strategy 7110, $7.60 is now 14. Going on the R1 R2 hit the 1.5 level move here. That occurs here at the 10:30. These are all coming up short here. Finally hits it and busts through it on the 10:30 a.m. The bid on the close of that candle on this one that we started at 15.9 is now $34.20. The 7100 that started at 11.20 is now 26. The 7110 that we started at $7.60 is now $18.70. Now at 10:40 a.m. we finally get a hit here of the R2 level. That's the 2-level move in your favor. That is the minimum ideal move. The reason why it's the minimum ideal move is that on 80% of the sessions that you'll see in a normal year, a 2-level extension from the bull bear key price level in either direction is going to be the extent of most sessions in a normal year in a normal trading environment. What that means is that the range S2 down to R2. That again is why the minimum threshold is the 1.5 level move. And we don't have the S1, S2 midpoint turned on because price went up bullish today. You simply turn on S1, S2, and then that would be your minimum threshold range, mid R1, R2 down to mid S1, S2. So on this 10:40 a.m. hit here, starting out at $15.90, now the bid is 44 on this candle close. 7100, $11.20, now $35 bid on the candle close. The 7110, $7.60, now $26.70 on the 10:40 a.m. candle close. Okay, so now we're going to move on to the early session lotto option trades. So the 7120, of course, was based on the 1.5 level move target level being the closest strike to that level. Started out at $5.20. When it gets to the R1 level here on the scalp only exit, $9.20. It's almost a double at that. Again, we're only starting out with a $520 purchase here, so you have to keep that in mind. When that one gets to the mid R1, R2 level, it is now $12.60 on the candle close. When it gets to the 2-level move, it is now $19.30. So we've gone from $5.20 to $19.30. For the furthest out of the money one, the R2, based on the R2 level, the 71.2884 level, that was the 71.30s. Those were the cheapest ones. $3.50, $350 per option. When it hits the R1 level, it is now $5.70 on the bid. When it hits the R1, R2 level, it is now $7.90 on the bid. And then when it hits the R2 level, it is now $13 on the bid. So $3.50 to $13. Now, one thing I do want to mention about stop losses with these particular lotto option trades is an alternative strategy, 2 stop losses, and this only applies to these early session lotto option trades. It does not apply to the other ones. So you can either use the same stop losses that you used here, either the tight stop loss or the standard stop loss, which was the 2 stop loss alternatives on this trade, just like you did with the regular strategy. Okay, so that's simple enough. However, there is an alternative strategy for these early session lotto option trades, and that is not using a stop loss at all. Now, why would you not use a stop loss at all as an alternative? Well, it's because in this alternative of not using one, you are instead utilizing the total amount that you are putting into the trade as your max risk amount. So in other words, if the total amount that you're willing to risk on a trade hitting a stop loss is X, and let's just say as an example, if the most that you're willing to lose on a trade, if it went back down to hit, regardless of which strategy you're trying to use here, and you can use this in trying to decide, you can use this methodology in trying to decide which particular strategy you prefer employing, whether you want to go with the standard 3-strike strategy here, which is utilizing the closest to this level, the midpoint above this level, or the R1 level as your strikes to consider using on this bullish trade, or if considering doing lotto option, early session lotto option trading using these 2 strikes instead, being the 1.5 level move away and the 2 level move away, an alternative to using the same standard type stop loss that you would use on these 3 is that you can instead look at it as on these trades here, if you were willing at the most to lose $350, then you could instead just buy one of these options here, being this option here, which cost you $350, and consider that one option that you're paying $350, that is going to be with no stop loss. So in that case, that is another way of doing the strategy where you can employ no stop loss, but that's only if you're using the cheaper options and only if that amount that you're paying for one option or however many options that you are utilizing is your max amount that you're willing to lose on a trade. So if you want to look at it in a corresponding way here, we'll move this back in. You can look at it this way. If the entry was here, if you were utilizing this particular option, let's say the closest strike here, the standard play, you're paying $15.90. If using the standard stop loss on this particular trade would put you down here, and if you got stopped out, more than likely this option is probably going to be somewhere in the 7 or 8 or 9 range. It just really depends on the implied volatility for the day and where the options are priced at. So there's a lot of different factors in play on that. However, when it gets down here, if it did hit the standard stop loss, then this may lose as much as, say, 50% of its value down here at this particular stop loss. That would be on one option approximately somewhere between $700 to $800, depending on where exactly it would fall in here, as an example. So if you're willing to lose up to $750 to $800 by utilizing that, and you could look at these in the same way. So if this was $11.20, if this stop loss got hit down here, the standard stop loss, this might be somewhere between 5 and 6. This one right here, which was based on this level here, might be somewhere between the $3.50 to $4 range. So again, in either one of these scenarios here, you're using that. Whereas if you're doing this here, now you could also just, like we said, you could still use the same stop loss here, and this is going to have some value. If it comes down and hits the stop loss, it may just go down to, say, 1 or 1.25 or 75 cents. However, the alternative is you could use no stop loss, and instead of, say, buying this option here and using the standard stop loss, or this option here, or this option here, you could instead, as an alternative to using the stop losses here on these, just consider buying only the amount of options on either one of these early session lotto option trades that would equal the amount of risk, or be equal to or lower the amount of risk that you're willing to risk on these standard play options. It's best if you are looking at possibly considering doing this early session lotto option strategy like it is in general, while getting used to any new strategy or any new indicator, to test this out on a demo account first, to get used to the process, to test out the process, and get used to trading it and see if it works for you. And then obviously you can also see whether using these stop losses here on either of these lotto option early session trades, or going with no stop loss and utilizing just the total amount you're willing to risk on a trade, and confining the amount of options you're willing to buy to that amount or less. Then once you have the process down, if you feel comfortable with the process, then at that time you can consider moving to a live real trade account where you are putting real money at risk. And that same thing goes for utilizing this indicator with the regular strategy as well. You always want to, when you're getting used to any new indicator, whether it is a paid indicator or even a free indicator or an open source indicator, it doesn't really matter. If you're using it on live trades, you're putting money at risk. So it's a good idea when you're getting used to any new indicator, whether it's paid or not, that or any new strategy, that you practice with it on a demo account for a decent amount of time to get used to the process of entering trades, placing your stops, managing your trades to exits, and managing any remaining runners if you're utilizing a scaling out and runner strategy, until such time as you become very comfortable with the process where it becomes secondhand to you, second nature to you, and at that time, then consider moving over to using it on a live real money account. Okay, so that's going to wrap it up for today's video. Just a couple more things I would like to go over before we end today's video. One is that we are having a sale at this time on our daily key levels indicators as well as our daily key level suite. Okay, so as you can see here, we are having a sale, a flash sale of $499 for lifetime access on all of our individual indicators. You can use promo code flash sale $499 lifetime, and that is good on not only the SPX daily key levels indicator, but all of our other daily key levels indicators. So if you just want to get an individual indicator, whether it's SPX or one of these other ones, you can use this promo code. This sale ends the end of this month at the end of 4/30/26. So end of day 4/30/26 is when the sale ends. So it's good from now till then. Also, we have a sale on our daily key level suite. You would use promo code suite sale 875 lifetime for that. This is over an $1,100 savings on the daily key level suite. It includes lifetime access on all 5 of our daily key levels indicators. The links to purchase the indicators will be in the description of this video, and also the promo codes will also be in the description of this video, and all this information will also be in the pinned comment of this video. Okay, the last thing before we end this video, some of you may be wondering how this indicator is working out for the people who have purchased it in the past and are using it daily. So what we'd like to do at this time is show you some of the user reviews and feedback we've gotten from traders who are utilizing all of our daily key levels indicators, including the SPX daily key levels indicator. So we will show you those now, and then you can also go to any of those links to purchase any of the indicators. And before you purchase them, you can certainly click on the reviews and look at the reviews for yourself, any of those links. Thank you again for taking your time today to watch this video. If you please hit the like button if you like the video, and we greatly appreciate it as that helps us out with the YouTube algorithm. Okay, so for those of you who might be wondering, well, how is this working for people that have purchased the daily key levels indicators? You can go to daytradinggps.com and look at the user reviews and feedback. We've just taken some of them here and highlighted parts of them, but we invite you to go to daytradinggps.com and look at the reviews and trader feedback on our various daily key levels indicators, including the SPX daily key levels indicator. Thank you.